Hi, my name is Bob Brooks. Today I want to talk to you about something I think that you really need to know, and it's how the stock market really works and what most people in the business don't even know. I've had this conversation with other advisors, and they've been surprised as to what I've talked about. And this is something so important for you to know because this would influence, I think, and change the way that you look at investing. I've done this in a lot of different seminars, and I've had people come up to me and say, I really struggle with understanding how the stock market works and what it means and all of that. But I tell you, what you talked about was very eye-opening and helped me to understand a lot better. And I'm hoping that that same experience is what you have, and just so that you can look at this a little bit more realistically. Now, let me say what I'm not going to do. I'm not going to talk in financialese. Now, this is something that people in my business have such a bad habit of doing. It's the language of investment spoken in such a way that no one understands. You're glazing over. You're saying, I just don't get it. I'm not going to do that. We're going to look at pictures. I'm going to make this very relatable. I love to talk about this. And I remember one time telling my wife, telling Sherry that I was going to, about to go do a seminar, and she looked at me and she goes, "Oh, you're not going to bore those poor people with bear and bull markets." And I said, "No, I'm going to talk about it and explain it. And so I'm going to make sure that you understand, because I do get the fact that not everybody relates to this, but at the same time, we all still have that burden of growing money and investing. So it's a matter of doing it the right way. So no financialese. Now, I'll say this: there is one part towards the very end that I'm going to talk a little bit about some numbers and whatnot, and it's just for those who might be interested, but I want to make sure that you get the main point of how all this really works. Now, let's go through a few definitions to make sure we're on the same page. What's a bull market? What's a bear market? A bull market is a market that goes up over time. Love the bull markets. People make money in the bull markets. Then there's the bear markets that go down over time. Imagine the value of your investment account going down. That's where people lose money. And what the industry typically focuses on, more so than anything, I'll tell you why in a minute, is the bull markets, because it's easy to make money in a bull market. What they don't focus on is the bear markets, because they don't have an answer for it. Now, if you've been watching any of my teaching videos, you know about Plan A and Plan B. Plan A is when the market goes up. Plan B is when the market goes down. And to be successful long-term as an investor, you've got to have a Plan A and a Plan B. It's very simple. And what the industry will want you to focus on, though, is the long term. And we're going to show this in a minute, is how the market goes up over the long term, and that's going to make everything okay. Well, you're going to be surprised as I show you that that's not really the case. So we'll talk about that. The other thing that I want to mention is when I say the stock market, what do I mean? And in media on the radio, we tend to talk about, when I host the radio show, I tend to talk about the stock market as if there is one stock market. There are several stock markets. There's the Dow Jones Industrial Average. There's the S&P 500. There's the NASDAQ. And there's a host of other stock markets. Today we're going to focus on the Dow Jones Industrial Average. And the thing about it is that I think that we lump all the stock markets in together because they typically all move in the same direction, some more than others. But this is what the industry shows you. They show you over a long period of time. And this chart, by the way to read this chart is just pretend this is your investment dollars at work, your retirement dollars. It's going up, it's going down, it's going up. And they'll say this is 1932 all the way up to 2016. And what they'll say is that over time, the market goes up. So you have nothing to worry about. Yeah, we go through some bad times, but over time, the market goes up. I'll never forget, back during the financial crisis, the financial services industry was in overdrive trying to make sure that everybody felt okay while they were losing money. And so there was a Charles Schwab commercial, and Charles Schwab owns a big brokerage company where hundreds of thousands of people have accounts there, and they have their investments there. And they were showing a meeting where Charles Schwab was going to attend this meeting and answer investors' concern during this financial meltdown. And you could cut the tension with a knife. I mean, you had all these people in there in a kind of a town hall setting, and they're very tense. In comes Charles Schwab, and I'm thinking to myself, this is going to be good. This is Charles Schwab. He's going to say something really, really helpful to these investors. And so the questions start flying. He says, Mr. Schwab, should I be selling my investment? Should I be getting out of the market? Should I be doing this? Should I be changing strategies? The questions were just coming from right and from left. All of a sudden, it gets very quiet. The camera pans in, and you're thinking, here it comes. And he says, I can't make this up. He says, the market goes up, the market goes down, but the market goes up. And I'm thinking to myself, are you serious? As that's the best you got for these people who are really concerned. So I'm going to show you what really happens, because what you need to look at It's not these big long-term graphs, because that doesn't fit reality. What you need to look at is what happens during time periods. So go along with me on this, and I think you'll really benefit. The first period, 1900 to 1922. Look at this. This is the value of your account all over the place. It starts here, it ends there. I feel like a meteorologist. It doesn't really move, it doesn't go anywhere. And that folks, that's 22 years. Does that look like a great time to be invested in stocks? Does that look like a Plan B environment? And then we go to the next area of time, and it starts right here. This is actually 1922 right here. You see the market goes up all the way up to 1929. 7 years of one of the greatest, most powerful bull markets where millionaires were made. That was the Roaring '20s. So you've probably read about that time period where people were betting everything on the stock market and making tons and tons of money. But that had an end date. 1929 to 1942. Look at this drop. 1929 down to 1932. That was an 86% drop. Can you imagine losing 86% of your retirement? That's what happened during that time period. Then it kind of meandered around. Basically, you started up here, and then all the way down to 1942, ended right there. Now, here's what the financial services industry, why they discount this. They'll say, well, that was a different error. That can't happen again. We have things in place to prevent that from happening. What I want to submit to you is this. The reason that this happens, the reason that stock markets can repeat things from the past is because this is all about human emotion. Buying and selling is driven by human emotion. And here's the reality of it, is that greed is greed, fear is fear, anxiety is anxiety, power is power, control is control. It's the same as today, as the 20s, as in biblical days. It doesn't change. So as long as humans are driving the market, yes, this is a possibility. Now granted, not a high possibility, but you have to know that in the back of your mind that is a possibility, and you need to prepare for things like that could happen. It's just like living in Houston. Now, Houston is not immune to hurricanes, but it's a low probability that a Category 5 hurricane is going to hit Houston, and it is a probability. So you can't live in Houston and just say, oh, that will never happen. You got to prepare for the possibility of it happening and be aware of it. So we go forward here, 1942 to 1966. Look at that. Stock market goes way up, big bull market. There's some bumps along the way, but for the most part it goes up, and this really fits that whole idea of buying investments and holding them, buy and hold investing. And the investors did great over that time period. Then you switch to another time period. Look at this mess. 1966 to 1982, it was all over the board, big drops in value, and investors lost money. And think about that for a second. That's a 16-year period. I ask the question again, is this a good time to be invested in the stock market? Would this be better served with a Plan B type attitude and mentality? The market didn't do very well at all during that time period. Then you transition to this chart. 1982 to 2000, an enormous bull market where so many people made a lot of money. Now, here's the interesting thing about this dynamic. 1982 to 2000, I would submit to you, was where the vast majority of people who are investing today were kind of born as investors. It's like being born with a silver spoon in your mouth. I mean, you can't ask for a better market trend than that. Over 18 years of the market going up and people making money. And so this is really all of today's investor knows, and the mutual fund industry kind of plays off of that, because the mutual fund industry looks at that from the standpoint of this is the way it's always been. The market always goes up, but you know different now that it fluctuates. So 1982 to 2000, and then you get this big bear market, over 50% loss. The market goes up in a bull market, big bear market, the financial crisis, down, and then you're up here now to 2016. Now let's talk about why this happens. Why does the market go through a certain period of years where it's rough to be an investor to a certain period of years that it's great to be an investor to it's rough? Said another way, why does the market go from a long-term bull market cycle to a long-term bear market cycle and keep repeating itself? And why has it done it all the way to the beginning of the stock market? It's simply this, is that in long-term bull markets, things get out of balance. And then you go through long-term bear markets to bring things back into balance. Then once things are in balance, then things start to get out of balance again. It's the rhythm of the market. I came across a great book back in 2002 that really changed my perspective of how I look at the stock market, and it's written by Michael Alexander, called Stock Cycles. In his body of work, this is the same thing. This is where I'm getting into a little financialese. This is the same thing, just in number form. You saw it in picture form, which I think is a little bit easier to relate to, but it goes back and forth. So what I want to point out is simply this. 1966, remember 66 to 82, bad time to be in the market. Then it transitioned over to this enormous bull market cycle, 82 to 2000. Then we're at 2000. Now, are we on this side or are we on that side? And it's a very important distinction to be made because it could affect how you go about investing. Now, what's interesting about this is that you could be 2017, 2018, the material's still very relatable, but I'm kind of making a forecast of where I think we are, and we'll see whether it's right or wrong. I still think we're over here. And having said that, if we are still over here, that means in 2016, where we are right now, we are heading into, and the market has really started off very poorly this year, we are heading back into a bear market cycle that would complete this cycle, setting us up for in a couple of years to be over here. We'll see what happens, but there's a lot of indicators that would suggest that's going on. Now, what is wrong with buy and hold investing? This is at the cornerstone of pop culture finance and what the mutual fund industry wants you to believe. They want you just to buy investments, stocks, and hold it. Even if you're losing 50%, just hold it because you're a long-term investor. To me, it doesn't make sense. It's never made sense. Why would you buy and hold through a bear market? If the market's losing 50%, why would you stick around for that? And I know that so many people that are big believers in this don't or do not agree with me on this, which is fine, but it's a flawed concept. I would say it this way: buy and hold investing works some of the time and not all the time. Whereas the mutual fund industry wants you to believe, and there's a reason for this, they want you to believe that it works all the time. The problem with that is that for the mutual fund industry, they want you to stay invested because that's how they make money. They don't want you pulling money out. They don't want you thinking. They don't want you making decisions. And that's what we're doing at the Vitality Network. We're helping you be a better decision maker and be a better thinker about what's going on and not being someone that just follows what the crowd's telling you to do. That's the key to success in investing. So history would show there are periods of time that stocks don't make sense. You see that. That's not going to change. As long as we have humans running the stock market and buying and investing, that's not going to change. The second, and this is so key to remember, listen to me carefully, the bad years do more damage than the benefit from the good years. I'll give you an example. The stock market dropped from 2007, in fact, I think I can find this slide, from 2007 down to 2009. Do you realize there's an 18-month period from this point to this point? That 18-month period wiped out 14 years of growth. Think about that for a second. You've grown your money over a 14-year period and you lose that entire 14-year growth in 18 months. That's what happened to many, many investors during the financial crisis. And so during times of market upheaval, the mutual fund industry will send out these, what I call them hand-holding pieces. They're for advisors to give and share with their clients to justify staying invested, that it's all going to be okay. Can't make this up. The one mutual fund company sent out a flyer that said, don't worry about what's happening because there's more good years than there are bad years. And that just totally misrepresents why that's the case. Sure, you should worry because you have to have way more good years because the bad years are so bad. It wipes out so many of the good years. And it's interesting to me that they would actually say that as a positive. Let's go forward. The third one, and the last two are my biggest issues with buy and hold. Buy and hold is a habit and a mentality. Think about this for a second. If you've been a buy and hold investor for 30, 40 years, that's what you know. You've seen the market come back, you've lost money, but you haven't needed it. So you go into retirement remaining a buy and hold investor because that's all you know, and you go through a real bad bear market, you're taking money out, you're retired, your portfolio drops 50%, and you find yourself having to go to work. Now this is because all you know is buy and hold investing. Now here is, this happened to so many people in 2000 when the market went up from 82 to 2000, is that they made so much money they decided, hey, I'm going to retire, and besides the market is going so much higher. And they lost over 50% of their money that was generating income, most of which had to go back to work. I saw this in so many people, and during that bear market, it was a bad situation. So it's a mentality, a habit. This is why it's important to change your habits now so that you're ready for and can transition into retirement, which we'll talk about in a minute. When you need the money, it might be the wrong cycle. What I mean by that is that, remember 1982 to 2000. If you need the money, let's say in 1985, that's going to work out pretty good for you because you've got basically 15 years of tremendous growth. But if you need the money in 2000, right before the market tanks, that's the thing about buy and hold investing. You don't know that you can't time out the cycle what the market's going through when you're going to need the money. This is why I think it's very important that we have an idea of how the market works. We have a plan A and a plan B mentality and develop that habit. It's something you develop over time, and so that when you get ready to retire, when you get ready and you need the money, you understand how the stock market works and you understand what you need to do.